Hey guys, Chris Clothier here, going live this week to our Facebook group, and I'm also recording my podcast. This is our podcast this week. What's the name of the podcast again? Because it's been so long. I feel like since I've been sitting here with you, Isabella. I'm teasing. I was about to call it the Experience Matters podcast. We are here this week recording the Grind podcast. My name is Chris Clothier. I'm your host, coming to you live from Memphis, Tennessee. And this week we're actually broadcasting live into the Facebook group. So if you're joining me on Facebook, how you doing? Be sure and leave us any comments, anything that you've got, any questions that you have, anything that you want to share with us. Throw it in there. Happy to answer them as we go. This week I actually have some questions of my own that I'm answering from some of our viewers, along with just offering some of my hot takes right now. Some of my takes on the real estate market, some of the questions we're being asked today by real estate investors. I've got a big question of my own I'm going to start the podcast with. And then I'm just talking about some topics that are actually very, very relevant right now. So with that, look, the question I wanted to ask the most, the biggest question on my mind right now is, what are investors waiting on? Why are investors sitting on the sidelines? And I only ask that from this one standpoint. I get a lot of questions in my email, in my inbox. I have the opportunity to talk to a lot of investors outside of here, whether it's, in my daily life, it's out there. We'll call it the real world outside of here. It's not always inside REI Nation. Sometimes it's just in what I'm doing on a daily basis. But I really am blessed to have the opportunity to talk to a lot of different investors. And look, I get the chance to answer a lot of questions and help a lot of investors move forward. And the biggest reason I am finding today from investors that they're holding back, they're sitting back, they're maybe not taking action. And I want to use that phrase so everybody understands. I'm not promoting the fact that I'm not saying any of the crazy stuff like now is I'm not like the band leader. Now is the time to invest. You're going to lose if you don't. It's the greatest investment period. I'm not saying any of that kind of stuff. I'm asking, why are investors waiting? When nothing fundamental about why we invest in real estate has changed. Now, some of the inputs have changed. Absolutely. I understand higher interest rates. I get that. I understand an environment where certainly in some parts of the country, not in the markets that we're in, but in some parts of the country, it was crazy. It was, you had to bid 25% over listing price, all cash, no contingencies, and close in 7 days in order to win a house that was listed on the MLS. And I understand that with the media, there's been a lot of stories out there about how negative real estate is right now, how you're going to be seeing a reset, massive drops. We're starting to see articles come out about foreclosures and the foreclosure filings going up. And that creates a bit of fear in the market. But if we invest with open eyes, with clear minds, and we have an objective, don't forget, we're buying a piece of real estate for the next 5 years. And I say 5 because that's like the minimum amount of time, I think, for a long-term buy and hold. But the reality is you hold it for 2 years. If you hold it for 2 years, you get massive tax advantages from that point forward. So, heck, let's just look at it like that. If we're investing for the next 2 to 5 years, what's holding us back right now? Well, I've spent a lot of time answering the questions of interest rates. They are where they are. We're kind of we're held hostage a little bit by other markets, other forces that kind of influence the mortgage rate market. And right now, mortgage rates are sitting, believe it or not, for the most well-qualified investor, they're sitting in the high 3s for their personal properties to low 4s. For an investment property, they're low 4s to high 4s. For medium qualified investors, that's the average. That's most of us out there. I put myself in that realm right there that have very good credit and have the means to be able to, their DTIs are in such a range where they're not paying extra points or getting dinged for, on their rates for, any external, factors. We're seeing high fives to low sixes. And the anticipation is could be some future adjustments. Now, I don't think we're gonna see anything going up a point higher, but I remember the days back in 2004, 2005, 2006 when I was getting rates in 7.5 to 7.75 to 8.25, and it was just simply a line item on your pro forma. It's just a line item on, am I going to make money or am I not going to make money? Which is going to bring me to another point here in a second. But so interest rates, they are where they are. Possibility they could go higher. If they're going to go higher, we need to be buying right now. We don't need to be waiting. If we expect them to stay at this level, why are we waiting? We need to be getting our money active and earning now. So that's the advice I give investors. If you know you want to buy real estate, you know you're going to hold long term, minimum the next 2 to 5 years, you're going to be holding to get the best advantage of taxes should you choose to sell, and also what's it doing going forward. I mean, look, now is a very good time to buy, and it could be slightly worse in the future if rates were to go up, but certainly not. Rates are not going to be dropping by a point or two anytime in the near future for us to hold our money in cash and wait. We need to be acquiring assets. Think again that cash is just paper. You know what I mean? It's given a value, for lots of different reasons. Of course, we know why cash is valuable, but the point is that we want to turn it into a hard asset. I do anyway. When I'm talking to real estate investors, that's the person I'm talking to. That's what we share in common. What we want to do is turn our money into hard assets that we can have a hold of and move forward with. So why are we not moving forward? Interest rates was a big one. Negative news cycle was another one. Fear. Rates are, what's going to happen if we return back to normal periods of appreciation? Well, you're going to appreciate anywhere from 5 to 9%, depending on the market you're in our markets anyway. You might only see 4% appreciation in some neighborhoods in some of the smaller markets. You might see anywhere from 12 to 15% appreciation in some of the better neighborhoods in our markets. So you're going to see positive appreciation if you were to buy now. Even if values come down. So I just bought 3 houses. I had an investor tell me I just bought 3 houses in the past 2 years, and all of them at this point I'm expecting them to go down in the future. And I told him, I said, well, they went up. One of them went up over 30% in the past 2 years, and they're expecting it to go down by 10%, which means you actually annualized increases of roughly 7% over the last 3 years. And that's only the projection for a full market. That's not a projection for your particular property, where you're at, where you're located. By the way, you're not selling anytime soon. He said, no, I'm not selling. I was like, so we're going to secure another increase in rent for you as your property goes forward. Your rents are appreciating. They're going up. By the way, part of my topic I'm fixed to talk about in a second, you're going to be filing your taxes next year. You're going to get another opportunity to take advantage of some of the tax advantages of real estate. I mean, there's a million reasons for us not to do things always, and we can find them, which is kind of where I'm going to next. Depending on glass half full, glass empty, fearful, conservative, risk taker, whatever your profile is as an investor, you can find whatever it is you're looking for. I encourage you, be careful what you type into Google, because if you're Googling, are interest rates going up, you're going to get articles that will tell you interest rates are going up. Are interest rates going down? It'll be the exact same thing. Interest rates are going down. You will get verification for whatever it is you're looking for. If you're out there typing in searches of, the worst side of real estate. Should I not buy real estate? Is real estate going up or going down? Is housing going up, going down? Is it a good time to buy? Is it not a good time to buy? Whatever whatever it is you want to read about real estate, you can find it, because there's lots of different theories and articles and all that kind of stuff being written out there. If you follow me, I'm certainly hoping and assuming that you believe, like I do, that real estate is a great investment. It's a great way to invest your money long term. Real estate are great assets to hold on to, and I happen to think we're a great company to manage them. So whatever you're looking for, the story you can find. If you want to move forward and get building your real estate and get building your portfolio, you can find plenty of reason to be doing that right now. Some of the biggest reasons to be doing that right now, for me anyway, look, this is the time of year we should start thinking forward to when I have to file my taxes next year. Are there any steps, anything I can do today to put myself in a good position? Number one, the best thing you can do for real estate, and this is something I've learned over time, is don't wait till the last minute. Definitely don't try and go buy a piece of real estate the last couple of weeks of December if you don't have anything under contract to maybe get one last bump. Because with real estate, I've got this article up here in front of me, there's a lot of things that you can write off in real estate, and not every investor is going to be able to do every one of these things. And please, this is not financial advice. Make sure you talk to your financial advisor or your CPA. But number one, mortgage interest is something that most of us can write off on our taxes. Property taxes, insurance costs, property management fees, and other professional services, including the CPA. Software and support system costs. If you use software to be able to track your real estate portfolio. Same thing with legal fees, closing costs, home office. If you're like me and you work from home all the time and I feel like I'm on 24/7, then home office is a deduction you should be looking at. Travel and accommodations to and from your rental properties. If you are somewhere far away and you invest passively, in any of the cities that we're in, and you come to visit your properties, you may be able to have a deduction on your travel and accommodations. Same thing with if you do any advertising, if you pay any repairs, not improvement costs, but repair costs, along with depreciation. All of this is stuff that you get to take advantage of on some level when you invest in real estate. And building a bigger portfolio, taking advantage of, all right, I want to build my mortgage interest deductions. I need to pay more mortgage interest. I have a bigger portfolio. Same thing with all of the taxes, the insurance costs, the fees, everything that goes into that portfolio. As you build your portfolio, the ability to get a larger and larger advantage, a tax write-off, is there. Consult your CPA. Depreciation cost over time, and this is massive for me. Real estate, you're allowed to deduct the entire expected life of a property over 27 and a half years. It's 39 years for commercial. But the reason why that matters is that you get to take just a little piece of the value of your property and deduct it every single year over time. The bigger your portfolio, the more properties, the better that is, the easier it is. Look, so somebody's asking in here, what about, what is the 2 years of ownership? What's the example of the tax advantages? So what I mean is, if you sell a piece of property after having owned it for 24 months, it shifts the gains that you make to a different bracket. It shifts them to capital gains rather than normal income. And I'm talking like I'm up here with the knowledge of this, and I'm really like way down here below the desk. Understand? But because you owned a property for longer than 2 years, you get to treat the income, the growth that you made, the profit, as capital gains rather than normal income. Capital gains, I believe, are taxed anywhere between 15 and 20%, whereas your tax bracket might be in the 20s, 25, 29, 30%, or 39%, as high as it goes, I think. So that's the advantage of holding a property for 2 years. Once you've held it for 2 years, you now get a reduced tax liability. That's what I was going with. All right. Some of the other things, and this is really big. We have a lot of investors. You'd be surprised that we have a lot of investors that right now they're thinking about taxes, but they're also thinking about, what do I have to be able to use to buy real estate? And a lot are coming to us saying, hey, look, I invested in property in the last 5, 6, 7 years, and I used a self-directed IRA. So I am building my income tax deferred. And because of that, I've got this buildup in here. I used a lender that would lend to my self-directed IRA years ago. That non-recourse financing was the best opportunity for me. It was a great opportunity for my self-directed IRA. But now I find myself with a massive amount of equity. So I have the property almost paid off. It's inside my IRA. It's producing an income. I want to be able to capture that equity and use it as leverage to buy another property. So therefore, it's not dollars in the IRA because I've already used the dollars in the IRA to buy my property. But it's the equity in that property. It's the pay down that I've had. So the money that's flowed through my IRA in rents and has paid down my principal. So now I want to come in and take that equity and I want to leverage it to buy another property. You would not believe the number of opportunities that we have right now in front of us, the number of investors. And if you're one of them, haven't really taken a look at that yet. If you use a self-directed IRA and you bought a property longer than 3 years ago, you most likely have an enormous amount of equity today in your property. It is an opportunity to supersize your self-directed IRA by using the equity in that first property to buy a second property. Not more cash. I'm not talking about having to put more money into it. It's, you're limited by the IRS and how much you can put into that IRA in a year. But you're not limited what you can do with the IRA in terms of real estate. Be careful with that one. There's rules around real estate. I'm not you would want to use a licensed intermediary, and we have lots of them, custodians that come in and assist you with making sure that you are following all the rules. But my point is, you don't have to put more money in. You can take what you have. You've already paid down your principal, plus you've grown in value. That has created equity within your IRA. The value is sitting in your IRA in that form of that asset. Now use that to be able to buy another property. We have a lot of investors that are coming to us and doing that right now. The other thing that's happening right now I understand, and I think investors should be looking at this and taking advantage of it, is can I use a 1031 exchange? So if right now is a good time to buy, I feel like real estate is going to remain in demand. I feel like rents are going to continue to increase. Even for us, it's nominal. We're not trying to drive anybody out of their houses with rent increases, but we definitely want to maximize the investor's opportunity while making it still affordable for the resident that is renting. So there are a lot of investors right now that are coming forward saying, I want to sell properties that I may have purchased 10 years ago, 11 years ago, and I want to purchase more property today. I want to cash out an asset from 10 years ago and buy a better, maybe a bigger, maybe a better investment long-term asset for me today. In some cases, investors are selling one and buying two because they have enough equity to be able to split that equity into 2 down payments and buy 2 properties today. We're seeing a lot of this today as investors, like you guys that are on the call with me, who are becoming more accustomed to what's, kind of what I'm going to call the new normal. I've been saying this for a while. You've got this, remember that curve I did a few months ago? Up here, this is the market where everybody's jubilant. It's amazing. We start having bad news and sentiment comes down. And then as people begin to understand that, and this isn't a valuation, this is just we're ready to buy, super, super happy. We think it's going to be great. I'm not quite so sure what's happening today. Back to a new normal. I'm highly confident that real estate remains a fantastic investment. This is where I am over here. A lot of investors I'm talking to are right here on this line. They're just trying to understand that, hey, I can buy real estate today. It continues to go up in value. Rates are going to hold steady, so I don't need to be waiting for rates to come down. Perhaps because I'm buying for the next 2 to 5 years, perhaps in that time frame, rates do come down. Now I can refinance to a lower rate, bring my costs down, boost my return on my investment property, and possibly even pull equity out to use as another down payment. I keep telling investors that we can what if ourselves to death. What if this happens? What if that happens? But the reality is real estate is an asset that is in high demand. People want to live. They want high quality. They want respect. And if you're buying the right properties in the right locations with the right management, you're gonna give those things. That's what we're focused on as a company. We're focused on treating the resident well so they stay in the house. Perhaps after they've been in the house, they want to buy it somewhere down the line. I don't know. The bottom line is we want to treat the resident the right way. Now, I like I said earlier, I get asked all the time about should we or should we not be buying real estate right now? A lot of investors, and I understand it. It is I want direction. I want to know why. I want to know why I should buy right now. I want to know how that a company like an REI Nation, like a Premier Property Management, is going to perform. How are you going to make this a good investment for me when interest rates are 2 points higher than they were 6 months ago? These are all great questions. None of these are bad. I mean, there's nothing wrong with asking it, but here's the answer. For years, we as investors have been taught to buy property one particular way. We've been taught that you open up an Excel spreadsheet and Bigger Pockets gives you 50 different versions of this. And to me, they're all crap. And I don't mean that in a bad way. I'm not knocking a pro forma. I'm saying that a piece of paper doesn't tell us anything. A piece of paper is a snapshot in time. A piece of paper gives us education. It helps us understand some things, but it doesn't tell us exactly what's going to happen. As an investor, I need to know why and how. Why buy right now, and how is this going to perform? How are you going to help me perform? I would love, if you're watching this, and I know we got a lot of investors that consume this live and some that consume it later on. I'm going to tell you straight up, I am looking for 2 or 3 investors, maybe more, 4 to 5 investors to be able to sit down with me 5-10 minutes. I need to pick your brain. I need to understand if kind of where I'm going is something that makes sense to you as an investor. We've gone back and we're pulling data, and I'm getting more of this data. We're data freaks. We've bought and sold probably close to 9,000 properties. We're managing today 7,500 of them. We're still buying and selling hundreds of houses every single month, dozens of markets. We're managing today the value, because values have gone up so much. We're managing, I would put it closer to $2 billion. We are super conservative with that number at about a $1.5 billion. We have a lot of data. There's a lot of lines of data that come through here, and sometimes that can be confusing, and you got to cut through and figure out what really matters. Well, let me tell you what I've been able to ascertain and what we're trying to get a better hold of to tell you as an investor. If you knew that in the next 5 years, it was highly likely, not average, I'm not talking average, I'm talking highly likely that your overall maintenance costs would be held below 2.4%. And if you knew that the longer I hold it and the bigger my portfolio, the likelihood of my entire portfolio coming back to the median of less than 2.5% in maintenance costs, and I could show you that with data, that's a how answer. Why do we invest in real estate? Because it's a fantastic hedge against inflation. It produces money in 5 very significant ways. We have, number 1, assets that appreciate in value. Number 2, we have the ability to depreciate that asset on our taxes. Number 3, we have the cash flow or the additional revenue that's created when properties go. Sorry, when we after we pay our bills every single month, we have the ability to earn that cash flow. We have the tax benefits. This is one of the only assets out there that you can borrow money legally to be able to purchase and then write off some of the costs of that entire transaction on your taxes. The IRS is encouraging us to invest into the housing market. And then the big one is, this is a massive hedge against inflation, is future rent increases. We're behind in housing. Housing supply continues to be low. Yeah, builders have come out and said they're going to build more houses this year than in years past. and it's perfect timing with the interest rates going up and demand going down. So for 1 year, it looks like we may build more housing than what may be needed. But the reality is that as those that want to buy these houses become more familiar with rent increases, they become more familiar with where we are as far as interest rates are going to be, they'll step up and they will buy these houses 100%. If not, then it'll be us as investors that will buy these new built house from the ground up that we will then turn around and offer to the rental market. So rent inflation is a massive reason to be investing in real estate right now. So we got all the whys down. Now the house, how are you going to help me make money? Well, if I'm able to say that and be able to show investors that, and these are averages, so I get averages, but over time, bigger group, over time, things revert back to the median, to the average. That's the law of averages. So if I'm able to tell you that for the first 5 years, greater than 30% of our homes experience zero maintenance. So if you're looking for a 2 to 5 year investment right now, and then we make decisions from there, that's massive. In year 5, the average amount of maintenance expense to our investors is $396. It's less than $400. We can't even make the customer service call on the $400 item in those first 5 years on the average, because the average isn't even $400. The high end of the average. So I've given you the 25th percentile, the 50th percentile, the 75th percentile, the ones that spend the most money. It barely goes over $1,000 in year 5, which I get it. That's a lot of money. I totally understand that. But it is, in year 5, it's roughly 5%, which means, again, when we look at the median for the first 5 years is under 2.5% maintenance. We were looking the other day at our average length of stay, and we tell investors that our average length of stay is over 7 years. So how are you going to deliver me a fantastic return? Well, when you subtract out the houses that we have not had the chance to renew yet, the median home for us, half have been occupied longer, half have been occupied shorter, is approaching 5 years, almost right at 5 years. That is absolutely amazing from a data standpoint. So when investors are saying, I don't know, should I invest right now? Should I not? Well, fundamentally, nothing's changed. Housing remains strong. If you provide high quality housing in the right area, there will be high demand both for resale and for rent. If you have a great management company that understands keeping the property occupied is the number one priority, it will continue to be in high demand. You'll have a management company that keeps your property occupied. Of course, I know that there's other companies out there that do a good job other than just us, but I look at our data and I tell you, this is the how. If you want to know how it's going to perform, this is how I know it's going to perform better than your expectations. If you run a pro forma and you put all your inputs in, you say, okay, I'll accept this. Our RPE is almost a worst case scenario of what is going to occur in that particular property. I am highly confident that we are going to beat that PE and beat those expectations in those first 5 years, because I've got the data that shows it, that the likelihood of us not only beating it, but absolutely crushing expectations is very, very high, because the data shows it. The data points it to us. The data tells us the hundreds, if not thousands of homes that experience no maintenance in those first few years. Forget averages. Just the simple fact that I know the percentage of homes, and I can give that to investors, the percentage of homes that experience none. And so you're able to make an informed decision on the likelihood that you have that, especially if you build out a portfolio. So I'm looking for 4 to 5 investors that can sit down with me. You got to be smarter than me. And I know there's a lot of you out there that understand numbers and data. But I'm trying to look for a new way to help investors understand real estate. Get away from the dumbed down version and get to the, hey, I fully understand and I really grasp the how. Why should we invest in real estate? That's simple, but how is this going to perform and meet my expectations? And it's all right here in the data. When you're able to look at it and say, okay, now I understand why REA Nation says you should not expect high maintenance bills. And over the longer you hold your property, this will begin to flatten out. Why you should expect a 7-year length of occupancy, because we perform to that. Why you should expect us to have rent increases every year beginning at month 18, because that's the data that's what we're performing to. We're putting all the pieces in place to perform to that high level. We're allowing, and what I'm hoping is that investors can see through all the tricks that you can do with math on a spreadsheet, and instead see that, wait a second, if I build a portfolio and hold it out over time, here's what I can expect in the next 2 to 5 years. And in that time frame, I'm looking around, do I refinance? Do I 1031 exchange? Do I hold? Because I'm beating my expectations. When can I begin to expect to see some higher costs everybody warns me about in real estate? And we've got that. We're able to show it. So I'm looking for a few investors that can raise their hand and say, hey, I want to talk to you, Chris. Let's sit down. Let's go through this and see what we can find. Until that time, hey, you can reply to me in here. You can also email me if you want. If you're listening to this week's podcast, you can email me at chris@reination.com. I knew what my email was. Isabel's looking at me like, did you remember? Of course I did. chris@reination.com. Email me. Let me know what you're thinking. I would love to sit down with a few investors and interview you a little bit and kind of let you help me. You're going to inform me on what it is you want to see and hear and what you think of the data, and does it really move you or not? Guys, until we get a chance to come again, I really appreciate you joining me for this week's podcast of The Grind. Thank you so much for joining me on the Facebook Live. I appreciate the comments that were put in there. Make sure you comment as you watch later on. Ask me questions. I'll get back to you. And until we get a chance to meet again, guys, commit to the grind. We'll talk to you. Thanks.